Here it is, up 1.2%. This is not what we were expecting. I was looking for a number between 2 and 2.5%. So 1.2 is arguably, a little better than half of expectations. And if you strip out autos, it actually improves a bit against expectations. That is, it's up 1.9. Expectations would have been around 1.2. And if you strip out autos and gas, it's up 1.5. So the last two are definitely better than market was looking for. And finally, the control number is a powerful 1.4 that will be inputted in other data points up the food chain. That's a very promising number. Many look at the headline number not necessarily as important. You strip off the onion levels and maybe you get to what is more important. Second quarter preliminary first glimpse at productivity, and it's better than expected indeed. We were looking for 1.5. This is multiples of that. 7.3. So this is actually one of the better numbers that I've seen going back quite a ways, as a matter of fact. This is I don't think we've been over 7% probably since '09. So this goes a long way back. And if we look at unit labor cost, of course, when productivity kicks up, so did unit labor cost. So we're expecting up 1.5 on productivity. We ended up 7.3. We're expecting a number around 7% on unit labor costs, almost double at 12.2. So these are really powerful numbers on productivity and outside of the retail sales headline. Now, let's look towards the interest rate complex, see if there's any reaction. There doesn't seem to be. Maybe we've moved a basis point higher in yield on 30s. But the important issue, I would say, is that we're holding those yield gains. The selling pressure in Treasury remains. And probably we will see industrial production and capacity utilization finalizing some of the big tech points of the week. Finally, in University of Michigan will come later. All things considered, any yield close above 70 basis points will probably keep the pressure on yields. Melissa Lee, back to you.
Rick Santelli, thanks. Steve Leisman joined us now with more. How are you digesting this, Steve?
A little confused, and this happens from time to time. The auto numbers, as reported by our great colleague Phil LeBeau, have been better. I was just looking at the July numbers. This is not in the data that you're looking at here. July auto sales, light vehicle sales, at an annual rate were up to 14.5 from 13.1 June to July. So there was an increase there in the number of autos sold, and yet here in this data here we have a decline. Where's our number here? Down 1.2%. So that's at odds, and that happens from time to time. Usually it's a timing issue. So I'm not too worried about the top line, and I think as a result of that, I'm encouraged by the ex-autos number, which is showing some decent strength. You had a big rebound. Electronics and home furnishing stores, just electronics and supply and appliance stores. I don't know if Joe maybe got a new washer dryer, what the deal was. I know he was getting his home together there, so that might have been an impact right there. You had a decent rebound in clothing and clothing accessories, up 5.7 after falling 21%. And Rick is right about this other number that feeds into GDP, which is the control number. That's why it's watched so carefully, and that's up good. So overall, I think it's a good number. You take out the ex-autos, I think they'll probably add that back in. But it raises that question for August, and that's really where we need to focus, and I think where the market is focused here, which is what happens.